Hey everyone, Ian King here, editor at Smart Profits Daily with your weekly market insights call. And again, this week I'm joined by my friend and colleague, Jeff Yastine. Jeff, how you doing today?
I'm doing good, doing well.
Yeah, getting ready for this week. I saw we had a incredible jobs number that just surprised everyone on Friday. There's been a little bit of controversy though now, Jeff. Some people saying that it was incorrect and that there were some numbers missing. Basically, the number came in at 2.5 million jobs were added in May, and expectations were for a loss of 7.5 million. The unemployment rate is now around 13.5%. There were expectations for as high as 20%. How do economists get this so wrong, Jeff? What do you think of that?
You know, I guess it's to be expected in some degree because you think about all the data sources that are coming in and all the possibilities for error. I guess in many ways, I'm surprised we don't get huge errors introduced all the time. And in many ways we do, because, as you know, a lot of this data tends to get massaged and revised on a pretty regular basis. In the following month, they'll say like, oh, we revised the number by this or by that. Mm-hmm. I think the important part is how, despite, what's a fairly significant result in terms of this error, that the market today is kind of shook it all off. I mean, I guess I expected when I heard about this error over the weekend that we might see another down day. And while that certainly could still come out, I find it fascinating that the market has just sort of shaken all that off and has continued to plow higher and not really retrace too much yet.
I mean, we don't have down days anymore, Jeff. What's a down day? When was the last time you heard the market had a down day? It only goes in one direction, right?
March 22nd, I think.
It sure feels like it. So that brings up another point, something that I want to talk about, because we're seeing unprecedented levels of Fed intervention right now. And what a lot of people need to understand is we had this great financial crisis in 2008, and the Fed did all these programs, and they went for the first time and bought treasuries and mortgages. This time is a little different, and here's why. The Fed is actually buying high-yield bonds for the first time. And I want to show our viewers this chart right now. This is the comparison between the return on different ETFs. So the HYG is the high-yield ETF. The LQD is the investment-grade bond ETF. And those are both up 24% and 16%. But if you look, the treasury bond ETFs are actually down over this period. What is the potential moral hazard we're seeing right now, Jeff? That the fact that the Fed are buying high yield bonds, like how is this going to play out in the next couple of years? What do you think of that?
Yeah, my view is, and I know other people have predicted this for a long time, the sort of what's the term? The Japanization of the U.S. economy by the Fed, in the same way that the Japanese central bank has just continuously monetized in the same way so much of their bond market and their forex market. We're seeing these first steps now, and I think the key is that once the Fed does this, which it has. There's really no going back. At least I don't see how they can sort of somehow move off stage right and expect the rest of the bond market to take over the natural part of the market without like a major dislocation. So it really is sort of a path of no return. But at the same time, for all of us as investors, what choice do we have? I mean, you buy treasury bonds and you're getting less than 1%. So it's having the desired effect of forcing everybody into the riskier part of the financial marketplace, stocks.
Yeah, I agree with you. I think this gets us to the point where the basis and the essence of capitalism is to the free market. We get to determine which companies are great, which ones stink. And if the Fed is just going to buy every single high yield bond out there and make it easy for bad companies to get credit, you run this moral hazard. I look at it as this is the participation trophy market. Everyone's going to feel good and these companies are going to feel great for a limited amount of time. But then what happens when the Fed has to take its pedal off the gas, And we should hope maybe that in a year when the Fed eases intervention, the economy is growing like it was back earlier this year, and then these companies will be okay. But you never know. I just think it's a huge moral hazard. And you're right, we're going to see some dislocations at some time in the future. But right now, you can't fight the Fed. We've been saying this every week for the last couple of months. You might think that this is crazy what the Fed is doing, but you can't disagree that what they're doing is actually working and lifting stock prices. So, pay attention to the reality that they're creating, not the one that you think should be right. And I think that's my big message, or it has been for the last couple of months. But let's turn to another reader question, because we see your comments and we got a question this week about Boeing. And on that note, I want to address a reader question now, because I think this is very relevant. And this comes from Dave S. And he says, Jeff, what do you think about Boeing as an undervalued stock? What are your thoughts, Jeff?
I think Boeing can qualify for that category, that characterization, eventually. But you have to have a longer term view. I mean, analysts think this year, because of the 737 MAX issue and of course everything with the coronavirus situation, that Boeing's going to lose around $4.50 a share this year. They've been fortunate that, as we were talking about the Federal Reserve earlier and its interventions in the bond market, that Boeing ended up not needing a bailout from the government, because the bond market was such, thanks to the Fed, that Boeing could step in and raise a huge chunk of cash it needed to sort of get through this period. So the question here is, what does the aviation market look like a year, 2 years, 3 years from now? Right now, analysts are thinking that Boeing will earn around $7.30 a share for next year. Again, presuming everything goes right with the 737 MAX rollout, and as well as the whole situation with the recovery globally from the coronavirus situation. But at the same time, you have a stock that's trading at $230 a share. So if you're buying it now, you're basically buying Boeing at 30 times next year's earnings. That's not exactly a bargain for a major industrial company like this that's not going to grow super fast, and depending on all the risks regarding, again, a global economy and whether we're coming out of a recession or whether we're somehow going into one, even if it's a mild one because of all the Fed intervention. So you've got, again, Boeing earning $7 next year, $10 a share the year after that, and around almost $13 a share the year after that. So the point is, you're going to have to wait a while. You're not going to see Boeing go back up to its old all-time highs of the pre-virus outbreak situation. It's going to take it some time to get back to those levels. But by my estimation, probably a couple of years to get back there.
Yeah, I don't know. In this market, it could be a couple of weeks, the way things have been trading lately. But let's be serious about Boeing. This is a company that's had a space program for decades, and it seems like in a matter of years, SpaceX just completely pulled out the rug from underneath them. And all the contracts that you would think that NASA would be working with Boeing are now going to SpaceX, which, it kind of worries me that whatever another kind of disruptive company has for the aviation industry, there's nothing planned right now, but at some point we're going to have electric planes, right? And if Boeing can't figure that out before a Tesla or another upstart, I think like their core business is really going to be in jeopardy. So I agree with you.
That points to another risk here, which I a while back, about 3 months ago, I gave an interview to a reporter from Al Jazeera, the North American operations, their technology aviation person. And I made the point to her that in some ways, Boeing, if they don't get their act together, for all the reasons you talked about, runs the risk of being the aviation world's version of General Motors or Ford, in that they're stuck making, basically the low margin items and having the reputation of, not being able to do things in the right way and in a cutting edge way, such as, again, as you pointed out, SpaceX. So that introduces yet another element of risk. There's also the chance that the global commercial jet market may be saturated, and that the overall demand for new jets just isn't going to be what it once was, especially if we see more of these electric jets and personal air vehicles and other things that may not be what we're buying a year from now, but 5 and 10 and 15 years from now, which is sort of the window that airlines and others make their budgeting decisions. It could spell trouble for the company.
Mm-hmm. Yeah, I agree with you. Kind of on a similar note, but I want to shift gears a little bit. There's something going on in this market that I'm starting to see, and it's a lot more speculative excess than we've seen in the past. And case in point, Hertz. Okay, so this is a car rental company that filed for bankruptcy a month ago. And I want to pull this chart up for viewers. So Hertz at one point was a $20 stock in March. And when they filed for bankruptcy in mid-May, it dropped to 41 cents, okay? So when a company files bankruptcy, usually the shareholders get completely wiped out. In this case, you saw about a 900% rally from that 40 cents because people started speculating, saying, hey, maybe Hertz isn't going to go bankrupt. Maybe they're going to pull their bankruptcy filing or something like that. But I want to note that the amount of Robinhood traders that are in this stock has doubled. So you're seeing a lot more retail traders, even though the largest investor in Hertz, who is Carl Icahn, decided to get out of the stock at 71 cents. Does this worry you at all that people are buying bankrupt stocks thinking that they're going to pull their bankruptcy filing in the future? I mean, what's going on here?
Yeah, Ian, I know you've been in the markets for a long time, and so have I. And we both have seen these kinds of crazy things happen again and again with these companies that are on the verge of bankruptcy, and suddenly they catch a bid as somebody speculates on Reddit or elsewhere that this company maybe they won't go into bankruptcy, and it just becomes a self-fulfilling prophecy as far as the stock price going up, and it's usually an unsustainable sort of thing. So it doesn't surprise me, and going back to what you were saying earlier, with the degree of intervention of the Fed, it sort of juices the speculative spirits, the animal spirits, but you have to watch where you're putting those because you could get easily burned. And I think in the case of Hertz, they rent cars. I mean, we have Uber, we have Lyft, and a lot of other possibilities. It's not like Hertz has some sort of lock on the car rental market. So it just shows you how dangerous this market can be, and how you have to be, as we've both said many times, you have to be smart about the stocks you're buying. I mean, unless you might as well just go to Vegas, as the casinos reopen, and just stick $20 stick to the $20 slots or something, because otherwise you're just blowing your money.
Yeah, I mean, if you go to Vegas right now, you're probably going to wind up with coronavirus. I don't know if you saw the videos over the weekend with the casinos open and no one wearing masks. So
right.
That's another thing to worry about. But the way I look at Hertz is this was a company that was probably slow walking towards disaster,
yes,
because of even before coronavirus, because you have these upstart disruptive companies like Turo that allow people to rent their own cars to travelers. And so you're creating this new market outside of these centralized rental agencies that I thought that, Hertz and Avis and Dollar and all these companies were going to be in trouble anyway. I think coronavirus just really accelerated. But one thing I would note is that Hertz is a huge high yield debt issuance. They've got a lot of junk bonds, and it's something the Fed is buying. So speculators are thinking, wow, look, if Hertz can get capital in the junk bond market like everybody else for a reasonable rate, maybe the stock isn't worthless. I mean, the market is the market, right? And the stock's up 900%. I don't know which way it's going. I wouldn't be a buyer here. And don't get angry at me if the thing goes to 10. I'm just saying that the risk reward profile from my perspective is just not what I'm looking for. I might have bought it at 40 cents or 60 cents or 70 cents.
As a speculation, right.
Right. But at $3 here, be very careful what you're getting into, especially when you see how many new Robinhood and retail accounts are in the stock. Jeff, this has been a great conversation, but let's leave it there. I want to thank everyone for tuning in this week. And if you liked our video, please hit the like button. you want to comment, any question, please leave a comment. We'll get back to you on this next week, and we'll see you next week. Thanks again.